Barclays Chief U.S. Economist Marc Giannoni is here, as well as our own Mike Santoli. Morning, guys. Good to see you both. First, Mark, your thoughts, I guess, about some of these calls over the weekend, raising recession odds, slower GDP growth, higher inflation. You're in line with those?
Very much so. We've been in line with the expectation that the economy is going to slow very significantly this year, and inflation is going to go up this year as well. So we had already marked down our growth forecast and marked up our inflation forecast right after the election result because we thought tariff would come in. But we had underestimated the extent to which we think now the tariffs are going to go up. So we now assume that tariffs are going to go up all the way up to 15% on a trade-weighted average basis. That would have a significant impact, in our view, on GDP growth. So we expect 0.7% year-over-year growth rate this year.
Yeah, I mean, it seems to me the market is kind of migrated to that type of a view, right? So you essentially have the bond market yields crashing, suggesting either it's mostly going to be a growth suppressant, not really pricing in the big inflation bump, unless the inflation bump is what's going to keep the Fed from moving fast enough to support the economy. Therefore, Fed makes the mistake. So that's the chain of logic. And as I look at the way the market's reacting today, to me, the big question is, has the cascade lower in confidence readings and stock prices kind of front-run this to some degree? I agree we're not going to get full clarity probably this week. But are we going to have any less clarity than we have today? Are we going to have incrementally more? Did we just have a retest of that sell-off correction in March because we kind of front-loaded some of the concern? I think a lot of people are wondering if it could be a very short-term relief trade because we at least maybe know what we're working with in the market, especially things like the NASDAQ, not directly tariff impacted. It's mega oversold.
It's an interesting point because we're not operating in a vacuum, right? Aren't we waiting for potential responses from other players, other state actors? And what kind of uncertainty does that feed?
Well, I think the uncertainty clearly puts the businesses on the side for a while in terms of capital investment and so on. I think we saw underlying the goods orders data that seemed to show like some front-loading of activity, front-loading of pieces and cars from abroad. I think the capital investment is probably going to be on pause for a little longer. And households, as you pointed out, I mean, households show a lot of uncertainty, show a lot of diminished expectations, deteriorating sentiment, and very sharply rising inflation expectations this year.
How do we think about also, though, the currency impacts with some of this and other countries potentially manipulating currencies as a counterbalance?
Yeah, I think the currency is going to do its thing. I mean, in response to a slowing economy, our exchange rate strategists, I mean, think that the dollars tend to come out more strong in response to the overall global disturbances here. So they expect like some appreciation of the U.S. dollar, which of course doesn't help U.S. exporters in that context.
Meanwhile, jobs, you're looking for, I think, 125 this Friday. And where do you think unemployment tops out in the year?
Well, so this is interesting. So we think payroll gains are going to diminish quite a bit from the strong prints we've been used to. We expect 125 this week, as you pointed out. We expect some significant deceleration for the rest of the year, going below 100,000, so averaging around 75,000 the rest of the year. But on the unemployment rate, we don't expect it to move too much up. This is the reason for that is that we don't have a lot of labor supply coming in. With immigration restrictions having been in place for some time now and continuing to get stricter and stricter, we expect very little increase in labor force this year.
So break-even number this year?
75,000 or so.
Right. Finally, Mike, what do you think about this successful defense of 5,500 today?
I think it makes sense. I think it was going to be the first effort. There's a lot of quarter-end noise with regard to these very big funds with these very known hedging strategies that they have to clear through in the opening parts of the market. I think the game right now becomes, okay, we basically went back to the old lows. Let's compare the intensity of the selling now versus then. More or fewer stocks making new lows. VIX higher or lower? So far, it's lower. So you might have things line up that say, yes, we've definitely kind of successfully had a bit of a tactical, retest here. The tricky part is you're asking people to wade in and buy a market at 20 times earnings. And the equal-weighted S&P is at 16 times. It's not cheap based on recent history. And almost everything we're talking about has more likelihood of putting earnings estimates down versus up. So I don't think it's a matter of, hey, we get an all-clear moment, But you could say we've already priced in a lot of the bad stuff, and the average stock is down more than 20% off its high coming into this week. It's not as if we haven't noticed all this uncertainty coming into this moment.
Still a lot of information headed our way this week. Mark and Mike, thanks, guys. Good to see you.